Fixed rate mortgages, standard variable, tracker, caps and collar, offset, discount. It's so confusing. I only understand this because I deal with it every day. In this video, I'll go through each of those 6 rates that I listed there, along with one pro and one con for each of them. There are multiple pros and cons for each of them, but I don't want to sort of like bamboozle you. So here we go. Fixed rate, exactly what it says on the tin. You are fixed in for a period of time. Most fixed rates operate for 2 years, 3 years, 5 years. You get some at 10. They're not so common these days. You're fixed in for that period. So, for example, 2 years, your rate does not change. So, therefore, your monthly payment doesn't change. A pro to that is peace of mind. You know, every month for the next 24 months, what your monthly outgoing is going to be on your mortgage. One con is you're stuck with that mortgage for that period of time. Just to quickly elaborate on that, there's early repayment charges. So on a 2-year fixed, it might be 2% penalty in the first year and then 1% penalty in the second year. If you were looking to move property, you know, life unfortunately brings you lemons. You might end up breaking up with your partner and you want to move house. To pay off that mortgage, you're going to have that early repayment charge. You do get some fixed rates with no early repayment charges, but the majority of them do come with ERCs. You'll be able to port that mortgage across to a new property, but if you decided you don't want to move that mortgage across to a new property and you want to pay it all off, then you're likely to have a penalty. Tracker rate. Now, these tend to follow the Bank of England's base rate. They will basically, it means your monthly payment can go up or down because your interest rate is going to move in line with the Bank of England's base rate or whatever rate it's actually linked to. One pro, it can save you quite a lot of money on a monthly basis if the rate dramatically drops. The downside is, you know, if rates go up or we have a hostile economy, then, you know, your monthly payment can go up. So it's really difficult to budget. With some tracker products, they do actually come with early repayment charges. Nationwide have been known to do a tracker product. It's called a switch to fix with no early repayment charges. So you go on a tracker, and then if you think that actually rates are going to start to go up, you can quickly switch that tracker from them to them with a fixed rate, no early repayment charges. Standard variable rate. Now, I've read that actually there's a huge proportion of people on this standard variable rate, and that's for one of 2 reasons. You've got people who've forgotten that they've come out of their tracker or their fixed rate product or, you know, discount, whatever the rate may be, and they've gone on to the lender's standard variable rate, which is, you know, in this current climate, it can be double, if not more than double, the existing rate that you're currently on. Secondly is, you know, where I previously said life unfortunately gives you lemons. If you were self-employed or even employed, and you've been made redundant, you've got no form of income, people feel like they can't actually move away. And sometimes you can't move away, and you are stuck on that lender's standard variable rate. One thing I will say to you is look at your existing lender, if this is you, and see if you can actually do a product transfer. Now, this isn't advice. You kind of need to actually speak to someone who's qualified like myself, but I think a product transfer could be an option for you. If your lender doesn't offer product transfers, then you're definitely going to have to speak to a professional. We may be able to move you over to another lender onto a cheaper rate. One pro is you've got the flexibility. You can effectively pay off this mortgage whenever you wanted to. So if you think that you're going to get some form of inheritance, for example, and it will clear the mortgage, then a standard variable rate might actually be ideal for you. One con is that rates can go up, and who knows what your monthly payment could be. If rates, you know, keep increasing, your monthly outgoing is going to increase. I mean, going back to the pro, you've obviously got that flexibility of remortgaging away, but what you don't want to do is find out the Bank of England have put their base rate up by 0.5%, and all of a sudden you've got another £300-400 a month coming out of your disposable income. That can obviously cause you some problems. You've got offset mortgages. Now, what is an offset mortgage? I'll try and explain this as best as I can. If you borrow, say, for example, £100,000, and you get a lump sum of, say, £20,000, You put that into your current account. So the offset mortgage is linked to, it's like a current account. And where you put that 20,000 savings in, you've reduced your balance by £80,000. Now, most mortgages allow you to make some form of overpayment anyway, and it's typically up to 10% of the balance per annum. Whereas an offset mortgage, it allows you to actually make more than that 10%. So if you work for an employer and you get a huge Christmas bonus, for argument's sake, you can just make that 10,000, 15, 20,000 lump sum, and you will only pay interest on the balance that you effectively own. So in my example, where it's gone from 100,000 to 80,000, you'll only pay interest on the 80,000. So you still have a monthly payment. You've got discount mortgages. What is a discount mortgage? A discount mortgage is where a lender, you're on their standard variable rate, let's say, for example, 5%. But they offer you a 2% discount for the first 2 years. So your interest rate's 3%. It's great to start off with. You've got those savings. It's ideal for those that want low outgoings initially. Currently, at time of recording, discount rates are no more beneficial than actually fixing. So that's why fixing and tracker rates are actually currently the most popular. But a discount rate, often or not, can actually save you some money to begin with. One thing you've got to be wary of is that rates can go up at any given time. So although you've gone from 5% to 3%, if the lender puts their rates up or the base rate goes up, then you're no longer paying 3%, you could be paying 3.5%. So it may have been cheaper to have actually fixed in to begin with. So yeah, pro can have cheaper outgoings to begin with. The con is rates can actually still rise, so it could actually work out to be more expensive. Last but not least, capped and collar. So what is a capped and collar mortgage? Again, these really, just like discounts, they're not that popular at time of recording. A cap is where the lender will state the maximum that your interest rate will go to, and the collar is the floor, basically the bottom. So your interest rate can go between those two. The pro is if interest rates are at the lowest, then it can actually be one of the cheapest mortgages in the market. The con is that if rates go up again, like the majority of mortgages covered in the variable range, they can actually work out to be more expensive. One thing I must stress is do not just look at the interest rate. A lot of people make this mistake, but there's more to purchasing a property or remortgaging a property than just the interest rate. You've got to look at the product fees that come along with that particular product that you're choosing, along with, are there valuation costs? Are there solicitor costs? Is there an application fee? These are all things you need to factor in. It's all well and good seeing an interest rate for 1%. But if the product fee is £1,500 you've got to pay for valuation and solicitors, you may as well pay the 1.25% where there's no product fee, no valuation, and free legals. So, one thing I must stress is please make sure you actually look at the overall cost over a 2-year or a 5-year or even a 10-year period, and not just the lowest interest rate, because you will be out of pocket. If you get stuck, please approach me. I'm more than happy to help you. That's what I'm here for. It's my job. I do this every single day. Now, I wouldn't be a responsible mortgage advisor if I didn't say your home can be repossessed if you don't keep up with the repayments on your mortgage. This video is not advice. You need to approach me or a mortgage professional, and we can actually give you the best rate that we feel fits within your circumstances. If you want to watch a video on self-employed mortgages and how to obtain one, please watch this video. And if you want to watch a video on how parents can help you get on the property ladder, please watch this video. Please make sure you subscribe to my channel. There's a bell icon that will give you a notification every time I upload a new video.